Welcome to the Deep Dive. Today we're digging into AbbVie Inc. That's ticker ABBV, a real titan in the biopharma space. And the big question, the one we're really trying to unpack for you today, is this. Humira, their multi-billion-dollar blockbuster, well, its patent protection is fading. So has AbbVie actually managed to set itself up for the next decade? Through smart acquisitions, relentless innovation? Or is it more like they're running flat out just to stay in place, facing maybe one of the biggest patent cliffs ever?
It really is a fascinating situation. And yeah, the challenges are definitely real for AbbVie, no question. But our deep dive, it suggests something pretty interesting. Their current stock price, around $185.30 as of June 20th, 2025. Well, it looks like it's trading right at the lower end of its estimated intrinsic value range, maybe even a little below. So that signals a really compelling dynamic for investors who, understand what's happening with this big transition.
Exactly. So our goal here is to give you that shortcut, to get you properly informed about AbbVie. We've gone through the financial reports, the industry analyses, expert takes, all of it. We want to unpack their business, look at the leadership, scrutinize the financials, and, crucially, assess what the future might hold. And to make sure we cover all the bases, we're splitting this into 7 chapters. This first part will focus on the core business, the management team, and the company's financial health. Okay, let's get started with Chapter 1, Business Analysis. So AbbVie's core business, it's really about finding, developing, and then selling innovative therapies. Stuff driven by research. You have to remember this is a super capital intensive field. It takes a long time. Huge R&D investment is absolutely key to keeping that pipeline full. Think marathon, not sprint, from lab bench to patient.
And their revenue is pretty spread out now across 4 main areas. Immunology, that was the historical bedrock, autoimmune diseases. Oncology is a huge growth driver focusing on cancer. Neuroscience for neurological conditions. And then aesthetics, which really got a massive boost from acquiring Allergan back in 2020. And that pattern, the strategic acquisitions like Allergan or more recently Immunogen and Cerevel Therapeutics, that's a core part of their playbook. It's about de-risking, diversifying away from just 1 or 2 big drugs.
Speaking of drugs,
Yeah.
you really can't discuss AbbVie without starting with Humira, the old guard, you could say. For 2 decades, it was the best-selling drug in the world. Pulled in something like $200 billion since it launched. It's just staggering. But crucially, it lost its U.S. patent exclusivity in 2023, and sales, they fell off a cliff. Went from $21.2 billion in 2022 down to $14.4 billion in 2023, a huge drop.
Yeah, nearly 50% year over year in Q1 2025 alone. That patent cliff, that's been the central challenge they've had to navigate.
Right, but then you have the new growth engine, Skyrizi and Rinvoq. These are absolutely the cornerstones of their post-Humira plan. And the growth has been explosive. Combined sales hit $17.7 billion in 2024. What's really eye-opening is management's projections. They're saying combined sales could reach $24.7 billion in 2025 and over $31 billion by 2027.
That's huge. It suggests they're not just aiming to replace Humira's lost revenue.
They think these two could actually exceed
Yeah.
Humira's peak sales.
Exactly. And beyond immunology, they've got other strong franchises too. Oncology with Imbruvica and Venclexta brought in about $6.5 billion in 2024. Neuroscience, led by Botox Therapeutic and Vraylar, that was around $9 million. And then the aesthetics business, Botox Cosmetic, Juvederm, that added another $5.1 billion. So together, that's over $20 billion in sales outside of Skyrizi and Rinvoq in 2024. It really shows their diversification now.
Yeah, much less reliance on just one product.
And it underlines their scale. They're global, operating in over 175 countries, 50,000 to 55,000 employees, market cap around $327 billion as of mid-June 2025. Puts them right up there with the biggest players in pharma.
So boil it down, their main value proposition is discovering and delivering these innovative medicines for serious health problems. And they try to do it with a patient-focused approach, building that brand loyalty. But how does all this fit into the wider industry picture? What are the big trends?
Well, looking at the industry, a few things really stand out. AI in drug discovery, for one. It's expected to drive maybe 30% of new drug discoveries by 2025. The potential is huge for shortening R&D timelines, maybe cutting preclinical costs by 25–50%.
Wow, that could be transformative.
It could, but on the other hand, you have intensifying pricing pressure, especially in the U.S. with the Inflation Reduction Act, the IRA. That brings in Medicare price negotiations, inflation rebates. It definitely constrains pricing power for the whole industry.
So a real balancing act there. How do companies like AbbVie adapt to that?
That's the multi-billion-dollar question.
We're also seeing the explosion of GLP-1 drugs, the ones from Eli Lilly, Novo Nordisk.
Game changers.
They're completely reshaping the diabetes and obesity markets. It's triggered this huge R&D race.
Absolutely. And then you've got digital health, telehealth, wearables, apps, creating new ways to collect data, engage with patients.
And M&A, mergers and acquisitions, that stays really active, right?
Right.
Driven by that need to refill pipelines as older drugs face patent expirations.
And competition.
Yeah.
Fierce. You've got the other big research-based pharma companies, J&J, Pfizer, Merck, Lilly, Amgen, Roche. They're all direct competitors. But the most immediate pressure, arguably, comes from biosimilars, especially for Humira now. These lower-cost versions just eat away at market share.
Right. And then there are the potential disruptors.
Yeah, smaller biotech startups, they might have cutting-edge tech like ADCs, antibody-drug conjugates, these sort of smart bomb cancer therapies, or personalized medicine. They could really shake things up down the line.
And the regulatory side, it's just incredibly tough in pharma. The FDA approval process in the U.S., notoriously long, complex, expensive. We're talking over a decade, potentially billions of dollars per drug.
And it doesn't end with approval. There are ongoing manufacturing standards, inspections, current good manufacturing practices, or CGMP. It's constant oversight. But what's really key here is how these tough conditions create huge barriers to entry. They protect established players like AbbVie. The R&D costs alone are prohibitive, over $2.8 billion per successful drug, they estimate, and many fail.
Like building skyscrapers knowing only a few will stand, as you said.
Exactly. Then the regulatory hurdles demand massive capital, deep expertise, intellectual property, like AbbVie's patent thicket around Humira, over 130 patents that creates legal walls. And finally, just sheer scale. Existing manufacturing, distribution networks, huge advantages for incumbents.
Which leads us nicely to AbbVie's own competitive advantages. Their brand strength is undeniable. Names like Humira, Botox, Skyrizi, Rinvoq. Doctors know them, trust them. That creates real stickiness.
And their size gives them real cost advantages, economies of scale in manufacturing, negotiating power with suppliers. And that $10 billion investment they made over a decade in their U.S. manufacturing footprint, that looks incredibly prescient now.
Way of that.
Well, it insulates key products like Skyrizi from potential U.S. tariffs on imported drugs that might come in 2025. It turns a potential industry problem into a competitive edge for them.
Interesting. And there's switching costs too, right? Especially for these complex biologic drugs like Skyrizi and Rinvoq.
Doctors tend to stick with what works, what they know, clinical inertia. Plus, dealing with insurance coverage changes can be a hassle. It builds a kind of moat around their products. But maybe their most critical, unique asset is that R&D engine. Around 90 compounds currently in their pipeline, across new areas like ADCs, targeted protein degraders. That scientific firepower, combined with patents protecting their newer drugs, that's the real source of future value. Which brings us to the people making the decisions. That's always crucial. Let's move on to Chapter 2. Management evaluation. AbbVie's leadership story is really one of deep experience and strategic continuity. Richard Gonzalez, the founding CEO, he really shaped modern AbbVie, maximized Humira, pulled off that huge Allergan acquisition. Now, Robert Michael is the current CEO, and he's taking over as chairman on July 1st, 2025. He represents that continuity. He's been with AbbVie and Abbott before that for over 30 years. He was deeply involved in diversifying the business and critically navigating that Humira patent cliff.
And their response to that cliff, it wasn't just one thing, was it? It was a whole strategy played out over years.
Exactly. Robust legal defense to protect Humira as long as possible. Massive R&D investment to develop Skyrizi and Rinvoq as the successors. And then strategic M&A, like Allergan, to diversify.
And the results? That ex-Humira growth platform, up over 21% in Q1 2025. That seems to speak for itself.
It really does. It's pretty clear evidence that the strategy is working. Now, communication and transparency, they follow the standard rules for public companies. SEC filings, earnings calls, that sort of thing. Their ethical reputation? Well, like many big pharma companies, it's a bit more complex. They definitely faced criticism over that patent thicket strategy for Humira.
Yeah, delaying the biosimilars raised questions about drug prices and access.
Right. It was legal, it was profitable for them, but it's a factor, for investors to be aware of. It shapes public perception.
Okay, let's talk capital allocation. For a company like AbbVie, how they spend their money is probably the biggest driver of long-term value for shareholders. They clearly invest heavily in R&D. You mentioned $2.05 billion just in Q1 2025, which is over 15% of their revenue. What about M&A?
M&A is definitely a strategic pillar for them, and they seem to follow a pretty disciplined, almost cyclical pattern. You have the huge transformative deals like Allergan in 2020 that was all about broad diversification, cutting that reliance on Humira. Then, after a mega merger like that, the focus shifts. They pay down debt, and they do more targeted bolt-on deals, like buying Immunogen for oncology tech or Cerevel for neuroscience assets, filling specific gaps in the pipeline.
So two-pronged approach, big bets, then smaller tactical ones.
Yeah, it seems less risky, more predictable than constantly chasing huge deals, and it's clearly delivered results.
And shareholder returns, that seems central to their story.
Absolutely, they're a dividend aristocrat. That means 53 straight years of dividend increases if you include the history from when they were part of Abbott. Since the spinoff in 2013, the dividend is up 285%. The current yield is around 3.54% with a quarterly payout of $1.64. That dividend is a huge part of the investment case for many.
And buybacks.
They have an authorized program, but recent activity has been pretty modest. Seems like paying down debt and funding that growing dividend are the priorities right now. And a key metric we look at is return on invested capital, ROIC. It tells you how effectively management is using the company's capital. AbbVie's ROIC is generally strong, typically between 17.9% and 20.3% on a trailing 12-month basis. Now, there was an expected dip after the Allergan deal down to about 5.6% in 2020. That's normal with big acquisitions. But the fact that it recovered so strongly, back over 18% by 2024, that shows they integrated Allergan successfully and are generating excellent returns on that huge investment.
Okay, so strategy seems sound, execution looks good. What does this all translate to in the financial statements? Let's dig into Chapter 3, financial analysis. All right, first up, the headline numbers. Market cap, as we said, around $327.65 billion as of mid-June 2025. A true behemoth. Revenue growth. Over the last 5 years, pretty consistent climb from $33 billion back in 2019 up to $56.3 billion in 2024. And importantly, in Q1 2025, year-over-year growth was strong, 8.39%. Beat analyst expectations quite comfortably.
And that's the net effect, right? Humira declining, but Skyrizi and Rinvoq ramping up fast enough to more than offset it. Now, profit margins. This is where you need to look closely. Gross margin is high, around 70.7%. Pretty typical for innovative pharma. Operating margin is also strong, roughly 30.4%. But the reported GAAP net profit margin, it looks much lower, maybe 7.2% to 9.6%. Why? Because of huge non-cash charges, mostly amortization related to the Allergan deal's intangible assets.
So the accounting makes the net margin look weaker than the underlying business performance.
Exactly. You really need to look at their adjusted non-GAAP earnings to get a clearer picture of their actual profit-generating ability.
And that profitability fuels their cash flow, right? You call them a prodigious generator?
Yeah, they really are. Reliable, too. Recently reported positive free cash flow of $15.4 billion. And for the full year 2023, cash flow from operations was a massive $22.8 billion. This huge, steady stream of cash. That's what pays for the R&D, the big dividend, paying down debt, and any future M&A they want to do. It's the lifeblood. Okay, financial stability. While those GAAP earnings can bounce around because of non-cash items, the underlying operational earnings, the adjusted EPS, show good consistency and growth. Their forecast for 2025 adjusted EPS is between $12.12 and $12.32.
What about that debt? The debt-to-equity ratio looks, well, alarming on the surface.
It does. $134.7 billion in liabilities versus only $1.46 billion in equity. Looks astronomical. But again, this is mostly an accounting thing stemming from the Allergan deal, those intangible assets and how they're amortized. A much better way to assess the risk is looking at their ability to service that debt. And given the enormous cash flow they generate, that ability is strong. They can comfortably cover their interest payments.
Okay, that makes sense. Any other flags on stability?
Well, the current ratio comparing current assets to current liabilities probably warrants keeping an eye on. The numbers suggest liquidity is something to monitor, though not necessarily a red flag right now.
But that dividend, we keep coming back to it. But 53 years of increases. That speaks volumes about stability, doesn't it?
It really does. It's a core commitment and clearly supported by that free cash flow. Exceptionally stable track record. All right, let's shift to valuation. How expensive is the stock? The trailing GAAP PE ratio, like the net margin, is distorted by those non-cash charges. Shows up as 75-79x, which is basically useless for analysis here. The forward PE, based on expected adjusted earnings, is much more helpful. It's around 14.5x.
How does that compare?
It's actually slightly below the average for large cap pharma peers, which is around 15.1x, so it suggests the market is pricing in solid growth, but maybe not spectacular blowout growth. Just for context, you see Eli Lilly trading way up at maybe 64x forward earnings, while Merck is lower, around 11x. AbbVie is kind of in the middle, maybe slightly cheap relative to peers.
And beyond just comparing PE ratios, what about trying to figure out the intrinsic value? We often talk about discounted cash flow or DCF. Remind us of the basic idea.
Sure. The concept is that a company's true value today is basically the sum of all the cash flows it's expected to generate in the future, but discounted back to their present value. Because, a dollar tomorrow isn't worth as much as a dollar today.
Right, the time value of money. So what does a DCF model suggest for AbbVie?
Our educational DCF analysis points towards an intrinsic value range of $195 to $225 per share for AbbVie.
Okay, and what are the key assumptions driving that range?
Well, first is the cash flow growth rate. We use a multi-stage model. For the next 5 years, driven by Skywizi and Rinvoq really taking off, we assumed high single-digit growth, say 8-9%. Then for years 6 through 10, we moderated that down to maybe 4 or 5% growth, and then a long-term terminal growth rate of 2-3%, kind of in line with inflation or long-term economic growth.
And the discount rate, how much you penalize future cash flows.
Right, the weighted average cost of capital, or WACC. For a stable, profitable company like AbbVie, we used a range of 8.0% to 9.5%. And importantly, a sophisticated DCF for pharma needs to adjust for risk in the pipeline. Phase 1 drugs are way riskier than Phase 3 drugs. So you apply higher discount rates to those earlier stage potential cash flows. We factored that in.
That's a comprehensive look at the financials and valuation. We've covered a lot of ground on AbbVie's core business and numbers. We'll take a quick break, and when we come back, we'll dive into what the market sentiment is, who actually owns the stock, and wrap up with the key risks and opportunities ahead. Stay with us. Welcome back to the deep dive on AbbVie. We've looked at the business, management, and financials. Now let's see what the broader market thinks. We're moving into Chapter 4, Market Sentiment. So what are the analysts saying? Wall Street seems generally positive on AbbVie, looking at maybe 28 to 36 analysts covering the stock. The consensus rating is basically a buy or moderate buy. Around 54% actually rated a strong buy. Their average 12-month price target falls somewhere between $211 a letter and $218 per share. Some targets go as high as $250. So that suggests they see pretty decent upside from the current price around $185.
And the recent news flow, the general tone in the media, it kind of echoes that what I'd call cautious optimism. The narrative really focuses on that successful pivot away from Humira, highlighting the strong growth from Skyrizi and Rinvoq. But the news is balanced. You see positive trial results reported, like for their migraine drug Qlypta or the cancer drug Imbruvica. But then you also see reports of setbacks, like a missed endpoint for another oncology drug, Venclexta.
So the market seems aware of both the potential and the inherent risks in drug development.
Yeah, it suggests a fairly realistic assessment is being priced in.
What about market indicators, like short interest?
Short interest is actually exceptionally low for AbbVie, somewhere around 0.90% to 1.05% of the shares available for trading. That's a really strong positive signal. It means very few large institutional investors are making significant bets against the company, even with those known patent cliff challenges. They're not shorting the stock heavily, and technically speaking, the stock price is trading pretty close to its 50-day moving average right now. That usually indicates some decent short to medium term momentum. It's also near its 200-day moving average, which is around $189.11. If the price can decisively break above and hold that level, that would typically be seen as confirming a bullish long-term trend. Okay, next up, let's look at who actually owns AbbVie. Let's talk about Chapter 5, ownership structure. AbbVie stock is predominantly held by institutions. Somewhere between 71% and 74% of the shares are owned by big players like Vanguard, BlackRock, State Street, JP Morgan Chase, Morgan Stanley. This shows strong conviction for professional money managers. Although it's worth noting, a lot of that is likely held by passive index funds that just track the S&P 500 or other broad indices AbbVie is part of.
Right, so not necessarily active bets on AbbVie specifically, but part of a broader strategy for many. Now, what about insiders? People within the company.
Insider ownership is very low, less than 1%. That's actually pretty normal for a company this massive, a mega cap stock.
Okay, but what about their trading activity, buying or selling?
This is where it gets interesting, maybe a little cautionary. There's been a pretty consistent pattern of open market selling by insiders over the last 6 to 12 months. And crucially, during that same period, there has been basically zero open market buying by insiders.
So insiders are selling, but not buying back in on the open market. What should we make of that?
Well, Insiders might sell shares for lots of reasons unrelated to the company's prospects, diversification, taxes, planned compensation. But the complete lack of any open market buying, that does tend to suggest that those with the closest view of the company don't see the stock as deeply undervalued right now. It's a signal worth paying attention to, even if it's not definitive proof of anything.
A yellow flag? Maybe, not necessarily red.
Something like that. It raises the question for you, the listener. How much weight do you put on insider actions versus, say, analyst ratings or your own analysis? And despite those large institutional holdings, ownership isn't actually highly concentrated. The top 25 shareholders own less than half the company. So it's a pretty broad and diverse ownership base overall, which is generally a good thing for corporate governance.
Okay, let's pull together the good and the bad. Time to get into nitty-gritty with Chapter 6. Risk assessment, using a SWOT analysis framework, strengths, weaknesses, opportunities, threats. Let's start with the strengths. These are the core internal pluses. We've talked about their robust, diversified portfolio: immunology, oncology, neuroscience, aesthetics. That's a big strength. They have that powerful R&D pipeline, maybe 90 compounds cooking, proven ability to integrate large acquisitions like Allergan, and of course their financial strength, generating tons of cash, allowing for those consistent shareholder returns, especially the dividend.
Okay, moving to weaknesses. Internal limitations. That legacy Humira dependency. Even though they're managing the decline, it's still an ongoing revenue headwind they have to fight against constantly. The high debt load, mostly from Allergan. While we said it's manageable because of cash flow, it does reduce their financial flexibility. It might make another truly massive acquisition harder in the near term. And there's always acquisition integration risk. They need to deliver on the expected synergies and the scientific promise from those recent Immunogen and Cerevel deals. That's critical, but it's not a guarantee.
All right, let's look outwards at the opportunities. Where's the future potential? The biggest one has to be their pipeline maturing and launching new drugs successfully, especially from those exciting areas like ADCs and oncology, or maybe even their early-stage assets in the obesity space like ABBV 295. Expansion into emerging markets is always an opportunity for global players. And leveraging personalized medicine, digital health, AI, genomics, using those tools to create more targeted therapies, maybe improve R&D efficiency, lots of potential there.
And finally, the threats. These are the broader external challenges. Intense competition is just a fact of life in pharma. Big rivals, biosimilars chipping away at older products, nimble biotech startups with new ideas, perpetual patent expirations. It's the circle of life for pharma. Today's blockbusters, Skyrizi and Rinvolga, they will eventually face their own patent cliffs down the road.
Right, it's a constant race to innovate.
Exactly. And then there's the ongoing pricing pressure and regulatory scrutiny, governments, payers pushing back on costs. Things like the IRA in the U.S. directly impact margins and pricing power.
Macroeconomic factors play a role too, right? Like inflation.
Definitely. Inflation pushes up costs, raw materials, energy, labor. But it's hard for pharma companies to just pass those costs on because drug prices are often negotiated or regulated. So it squeezes margins.
And interest rates.
Higher rates make borrowing more expensive for funding R&D or M&A. And it increases the interest expense on any existing variable rate debt they might have. And it's worth circling back to that specific geopolitical factor, the potential U.S. tariffs in 2025.
Right, the ones that could hit imported drugs and ingredients.
Yeah. For many companies, that could mean higher costs, maybe supply chain headaches, even drug shortages. But AbbVie, because of that big, proactive $10 billion investment in their U.S. manufacturing, they seem well insulated, especially for key products like Skyrizi. So what could be a threat to the industry might actually be a relative competitive advantage for AbbVie. Quite a strategic move, looking back.
Okay, we've covered a lot. Strengths, weaknesses, opportunities, threats. Let's bring it all together as we arrive at our final insights in Chapter 7. Conclusion.
All right, let's synthesize this. First, the bull case for AbbVie. They've arguably executed a masterful pivot away from Humira. Skyrizi and Rinvoq really do look poised to potentially exceed Humira's peak sales. That's huge. They have a deep, innovative R&D pipeline that should fuel future growth beyond those two. Their capital allocation is very shareholder-friendly, that rock-solid dividend discipline M&A strategy. They possess a pretty strong economic moat built on those powerful brands, economies of scale, and now that strategic U.S. manufacturing footprint. And based on forward-looking operational earnings, the stock appears reasonably priced, maybe even slightly undervalued relative to peers.
Okay, that's a compelling bull case.
Oh.
But we have to balance it with the bear case. That massive debt load from Allergan, while manageable, still hangs there. It does limit financial flexibility for future big moves. The entire bull thesis really hinges on continued, almost flawless execution. launching pipeline drugs, driving growth for Skyrizi and Rinvoq. There's not much room for error. They operate in a brutally competitive industry. Relentless pricing pressure, regulatory headwinds like the IRA are real and ongoing threats. And then there's that cautionary signal from the insider, trading all selling, no buying. It suggests maybe the stock isn't perceived as a screaming bargain by those on the inside right now.
So bringing it back to valuation, our educational discounted cash flow analysis, remember, suggested an intrinsic value for AbbVie somewhere in the range of $195 to $225 per share.
Which leads us to our concluding outlook. As of June 20th, 2025, AbbVie's share price is $185.30. That puts it trading right at the lower end of, and actually slightly below, our estimated intrinsic value range. So for investors who have confidence in this management team's ability to keep executing to commercialize that pipeline successfully, this could represent an attractive entry point, especially if you're looking for long-term growth potential combined with that significant dividend income. And maybe a final thought to leave you with. Given how well they've navigated the Humira cliff and how strong Skyrizi and Rinvoq look now, how long can these new drivers sustain their momentum before the next patent cliff inevitably looms? And how is that powerful R&D engine already preparing them for that future transition? Something to ponder. If you found this deep dive valuable, please do like and subscribe to the Stock Analytics AI YouTube channel. And remember, for €4.99 a month, members get priority deep dives on tickers you suggest, plus exclusive S&P 500 stock videos every single day. Feel free to add your stock suggestions in the comments below. We do pick them up.
And just a reminder, this analysis was generated by an AI system. It's intended for educational purposes only and should absolutely not be taken as financial advice. Always do your own thorough research or consult with a qualified financial advisor before making any investment decisions.